Wook Capital Management Inc. and its employees solely provide investment advisory services to family clients and do not provide investment advisory services to the general public. Furthermore, investments are highly speculative in nature and involve substantial risk of loss. We encourage investors to obtain advice from your professional investment advisor and to make independent investigations before acting on information that we publish. We cannot assure you that the information is accurate or complete. We do not in any way warrant or guarantee the success of any action you take in reliance on our statements or recommendations. Past performance is not necessarily indicative of future results. All investment decisions of an individual remain the specific responsibility of that individual. Okay, with that mouthful out of the way, thank you for joining us this evening for our latest edition of our monthly Wook Book Club. We're going to be discussing themes and takeaways and such from One Up on Wall Street by Peter Lynch, which fittingly came out the year I was born, 1989. So while there is, of course, a lot of dated company-related references sprinkled throughout the book, there's certainly some good kind of references for the 70s and the 80s. I think it is still relevant, and a lot of Mr. Lynch's notes, I think, hold up even 30, going on 35 years later. For those who don't know Mr. Lynch, Peter Lynch was the fund manager at Fidelity's Magellan Fund. I believe it became the world's largest mutual fund, and he had a fantastic run for many years. He outperformed the S&P 500 all but 2 of the years which he ran the fund, which he took over in 77. And I know he ran it through, I think, until the 90s, early 90s, between 90 on the dot. So Lynch ran this fund. It had a huge swathe of holdings. He was renowned for having hundreds, if not thousands, of stocks in that portfolio. So the book touches on some of the different ways in which he thinks that investors, any old retail amateur investor, can approach stock picking and investing and portfolio construction and the like. So I think it's a very beginner level book that also touches on things that are still insightful, even if you're not an investing beginner. So I have a bunch of my own notes. I'm sure that some of the folks who are here on our panel, which includes the Wook team and our friend Ted here, have their own notes. I guess I'll maybe open it up because, Joe, I know you're going to post a little summary here to pin to the nest for folks who maybe aren't as familiar who decide to tune in. But I guess instead of going maybe chronologically, I would go around the panel and say, maybe pick out one thing from the book that stood out to you, that left a lasting impression that you think a reader really should ensure they walk away from the conversation or from reading the book and remembering. I'll go first, and one aspect of the book that I really liked was where Mr. Lynch breaks down kind of every investment type into just a few select buckets. And remember, when we're talking about investing in this context, we're thinking about it from an ownership kind of lens, right? We're less concerned about share price, and we're more concerned about what the business that we're buying and investing into is doing and will look like, et cetera. So what I enjoyed was how he very simply and succinctly categorized stocks into really just these, I think, 6 categories. It's your slow growers, your stalwarts, your cyclicals, fast growers, turnarounds, and asset plays. And he voiced the perspective that most every listed stock will fit into that one of those best. So I really like that because I think it helps in the way he approaches explaining the book. He kind of highlights the different considerations and metrics you need to think about for companies that fit into those categories. And I'm sure some things might have characteristics that overlap beyond just being a cyclical. Maybe they are an asset play, but generally, right, I think it was a nice framework of thinking about approaching your stock picking. Slow growers being maybe a utility company, which, as Lynch points out in the book, a slow grower was probably a fast grower who has matured into maybe the industry, right? Utility companies were at one point, in the 40s, 50s, fast growers and became slow growers. They pay out a consistent dividend, yada yada. Stalwarts companies that um, uh, are your solid growers that grow faster maybe than average. Cyclical, of course, understand the definition. Fast growers would be our AI stocks of today, right? Turnarounds would be where there's some special situation. Maybe they've gotten into debt. Maybe they're doing a restructuring, and asset plays where maybe the listed value of the assets on the books are not recognizing the full value. So let me not ramble on too hard. But yeah, that was the one of the takeaways from One Up on Wall Street that I thought was a good framework that I'll think about for sure going forward. Um, Welcome whoever is next on the panel who, yeah, want to share maybe the one big thing that's their takeaway.
Yes, I'll go. So I guess we're just picking out like which chapters we liked, right? So, I like chapter five. It's talking about how like don't try to predict the market, and anything that you were taught in academia is oftentimes very wrong. And it even talks about one of his schoolmates who went to Harvard, or not schoolmates, he went to Wharton, but like this other guy who was all into investing, and he went to Harvard for grad school, and he had to pretty much unlearn everything because everything he learned in school is not really applicable. Like market goes up 9% a year on average, that never happened. Recession happens every 5 years, that never happened. So he's pretty much saying like you don't have to be so financially educated in the academia world, and you can pretty much gain profits by just carefully observing your surroundings, because at the end of the day, you're doing the research you need to do. That's actually the one of the best way to do research, like going to Dunkin' Donuts and eating their donuts and just observing your surroundings. So I thought that was good. And he goes on to talk about how like don't try to time the market, the economy. Those are all pretty much all waste of time. And the only thing you should really be focused on is looking for undervalued and underappreciated companies, and find great valued companies and that are profitable. Just ignore all the short terms, and um, like really it really focuses on don't focus on the economy at all. Like it doesn't matter how the Dow Jones Industrial Average is doing. Don't worry about any of that. Just focus
Except
on
for
the company.
cyclicals.
Except for cyclicals, yes, if you time it improperly, then he said that you could be down up to 90%. And so if you're trying to time that and you time it incorrectly, be prepared to lose massive amounts of money. But if you do time it correctly, you can make a lot of money, but something very difficult to do. But yeah, so I like that chapter. And obviously the book, a lot of the core ideas and his philosophy revolves around what was just mentioned. So, I mean, there's a whole bunch of other chapters that are very important too, but um, yeah, yeah. So I like this one.
Yeah, so JP, thanks for that. Before I let anyone else kind of chime in on their maybe big takeaway from the book, we'll go on from this. Kind of let folks who want to share their takeaways or big takeaway, and then we can go kind of. He has the book set up in three parts, so I think we could maybe discuss them in part order and talk about the chapters and maybe takeaways within those parts. So that's the framework for how I'd like to maybe approach this discussion on Lynch's One Up on Wall Street. So JP, thank you. Joe, Han, Ted, thoughts on one big takeaway or takeaways from the book?
The most interesting part for me was the 13 kind of attributes that Peter lays out here, describing what the perfect company looks like. And I saw a lot of parallel between these and the AltaFox Capital report that we all read. I think about probably more than a year ago. But for context, the AltaFox Capital's multi-bagger report is so AltaFox is another similar investment fund, and they asked their interns to look into all the companies that had crazy growth. It's multi-bagger companies. The report is called "The Makings of a Multi-Bagger." By the way, maybe we can even throw that on the nest, Rod. But "Makings of a
It's
Multi-Bagger"
up
is
there
a
now.
great, good, thank you. Yeah, so this report explains the key characteristics of the companies that had explosive growth in the past. And some of the companies, when we were going through the report for the first time, I remember being surprised by how dull, how kind of behind the scenes, how not fancy or splashy all these companies are, but rather they focus on the key technologies, the key advantages that they have, and really know how to use that to their fullest advantage. So they really understand their technology and their industry. But to a lay investor like us, when I was going through it, it sounded almost too dull to learn more and too hard to understand. But now, having read One Up on Wall Street, there's a lot of parallel between the multi-bag, between the characteristics identified in this report versus the 13 attributes that Peter Lynch explains here. Like, for example, he emphasizes the perfect company is a user of technology. Like I said, the perfect company is often dull. Probably nothing ridiculous in the AltaFox report, but definitely dull. A lot of focus on tech and healthcare industry. I was kind of reading through it. It's interesting to see all this parallel between what Peter Lynch wrote all these years ago about what makes a perfect company, what makes a multi-bagger, 10-bagger, and what a fund like AltaFox can, the conclusion that a fund like AltaFox can reach by just looking at the past few years of data. It's interesting to see all the parallel here.
I think it's a really, really good point that even looking at a time period that's 30-ish years past the publication of the book, those attributes generally still hold true of your dull niche. Uh, Maybe it's low growth, it's not sexy, maybe it does something people don't like. All these sorts of attributes that are laid out by Lynch and that the pinned makings of a multi-bagger AltaFox analysis kind of also align that. That's a great point, Han. So it's great, I think, for investors who are actually trying to think like investors, maybe in this current market landscape where AI stocks are going to the moon. It's frustration for longer term oriented investors. Um, but I think that it's great to kind of make that corollary that the attributes, people across decades doing the work, kind of finding the similarities there. So great call.
Definitely. Yeah, I think we all agree that the market now, especially in the past week or so, and it has been absolutely crazy. And this is the definition of hype market. And right now is, it's a better time than ever to focus on the fundamentals and keep drawing these parallels from lessons, the classic lessons that have survived, the test of the market over decades.
So, Han, I'm going to jump in before, if Joe or Ted wanted to chime in, just before they do. I had jotted down from the edition that I read included his foreword around .com era. So he had made note, quote, "These so-called advanced decline numbers paint a more realistic picture. Never has this been truer than in the recent exclusive market where a few stocks advance while the majority languish. Investors who buy undervalued small stocks or mid-sized stocks have been punished for their prudence. People are wondering, how can the S&P 500 be up 20% and my stocks are down? The answer is that a few big stocks in the S&P 500 are propping up the averages." It's incredible, right? Those words could have been written this past week, but no, they were written during the .com bubble by Mr. Lynch, and of course, it's very difficult to know when you're in a bubble sometimes, and uh, of course, it's especially difficult to know how far they can go on for. But I think it's very interesting when I read this, kind of seeing the corollaries to the exact market landscape we find ourselves in. Where it's just seven of the top 500 S&P companies really carrying all the weight. So very markets again going back to Mr. Marks, right? Markets seem to operate in cycles. They won't always be identical to one another, but they certainly have rhyme. But Joe, Ted, did you guys have any major takeaway or takeaways that you'd like to share?
Yeah, I mean, it's obvious to me. Peter Lynch was a genius, like, of his time, right? I think the book shows some evidence of being dated. Like, there's some talk relative to technology that, like, when I would read it, and it would become clear to me that the book is as old as it is, it would discredit some of the rest of the book because would begin to worry if, like, everything else holds true when some of that is clearly not, like, recent. So maybe an update to the book would be appreciated, but you can't have everything, right? Essentially, for me, at least, I found the book it was really well written. It was, like, easy for any person to understand, despite those you know evidence of the age. Like, every time he would use an acronym or anything like that, he would kind of explain what it was. So I read kind of like a story. I went over some of his um, personal successes, right? And told people from his perspective what he's done. And I love hearing that. Like, if I was to try and do the same thing, like tell the same concept to somebody, that's what I would do, is I would tell them about GameStop, right? And there's obviously so many parallels. So I like that, going over the personal stories to try to explain the concepts. And he also talks about his failures, right? Like, he talks about a few different times it just didn't work. And that's kind of the importance of the 10 bagger, because when you get, a 10 bagger, you can have those few companies that didn't 10x, or, because you're going to do fine anyway. So, overall, I liked it. I enjoyed it. Like I said, I drew a lot of GameStop parallels, especially when it comes to, like, his talk about how retail investors have power because they can they can buy a stock without moving it. I mean, I find that. I mean, it's true in some ways. Like, that's a good thing and a bad thing. You can kind of move in and out of a position without, making a tidal wave. But sometimes that's good, right? Some traders prefer that, and making a splash when they buy something and moving the price, and watching other like, market effects from them taking the position. So I liked it. Um, I think that there was a lot of great concepts. I do wish that there was, like, a revised version or, like, an update with a few pages that just kind of, like, brings it into the modern era a little bit. But besides that, I think it's aged pretty well.
Yeah, it's funny to read the line. Obviously, him writing it in 1988 or 89 or whatever about not what was it? Um, I've never. I, I don't visit the web. I've never surfed on it or chatted across it without expert help. I couldn't find the web, right? A line like that, obviously, for us, we're having a
Yeah,
conversation. I think there's, we're calling in from several different continents right now. So the telecommunication and technology changes are vast. And it, to that point, though, a lot of the investment discussion he makes is that people would do better to invest in what they understand and what they know. And I tend to think a lot of these technology stocks, people don't truly understand. I mean, everyone is different. We're talking about semiconductor companies and who's the best chip designer. I'm inclined to think that most investors really don't know that sort of stuff at all or have any deep insight. Look, not saying that investors shouldn't invest in semi companies, but just I think from what he discusses in the book, it's easier to understand that which you know and that you touch and interact with, whether as a consumer or in your business life. If your job involves you seeing that industry or that sector or whatever. So, yeah, it would be interesting to see an updated version touching more on how ubiquitous technology has become and how to try to apply the thinking, um, to I mean, it's just hard to invest in technology, I guess. It's the simple way of putting it. But
Yeah, because otherwise, I mean, the prologue is Lynch's skepticism, like on the internet. He talks about he doesn't use the internet at all, and I think when you're in the modern era and so much investing is based on the internet, it's just it ruins some credibility in my opinion. Seeing that and then reading an entire book from the perspective.
yeah, I don't think you were alive back then. But that's, most people didn't use the internet until after the turn of the century, really, right? Like the 90s were the big uptick in internet usage. Um, and I mean, it's obviously a very steep curve, but yeah, in 1995, just 14% of US adults had internet access. So that number ramped, by 98, or rather by 99, you finally got to half of, the population, or past half the population. But yeah, I mean, I remember dial-up internet and, you know, that stuff from the 90s. And I was very lucky. I had access to the internet before most people in the early and mid 90s, um, growing up. So, but I think it's a good point. If you're a younger reader, you probably don't truly appreciate that the internet is an invention that didn't really ramp until 20, 25 years ago. And it wasn't unusual for people to, not use the internet in the 90s, right? But yeah, good call out. Okay, Ted, I don't know if you had an item or a call out, or before I move along.
Yeah, sure. I mean, one of the things that I enjoyed about the book, there was a discussion in chapters 2 and 3 where Peter Lynch kind of goes through the differences between, or kind of he draws a distinction between the advantages that kind of a non-professional versus a professional fund manager has. And on pages 65 and 66, he kind of goes through a number of arbitrary rules that institutional fund managers abide by. And he, like, within that vein, like, Lynch says that he tries to think as an amateur as frequently as possible. And some of the rules was like certain fund managers can't invest in certain industries. They can't put more than 5% of their assets in any particular issue. There's certain like market cap rules, and they play by like a quarterly performance game, whereas kind of the non-professional doesn't have to abide by those kinds of rules, and they could use it to their advantage. And then another thing that he teases out is kind of you could use your background in terms of your day job as a form of alpha. So if you're a teacher, if you're an engineer, whatever it may be, you could use your day-to-day job in terms of what you're seeing as a source of alpha to pick out stocks. And then another thing too, on page 14, there was an example. He talks about .com, and he basically works through the math of, instead of trying to project a company's earnings to determine value, you kind of work backwards. So in the case of .com, he was saying how at a certain market cap, you could kind of assign just like an arbitrary PE multiple to it to see what a company is baking in, or basically like reflecting from an earnings perspective. So I think it's interesting to kind of draw that to something like NVIDIA today. So the company has a market cap of like approximately 990 billion. So for NVIDIA to be a 10 bagger at this point, the market cap would have to go to close to $10 trillion. And if you assume some kind of a generic PE on that of like 40 times, the math works out to be $280 billion in earnings, or net income. And I'm pretty sure if it's not the most profitable company on an absolute dollar basis, it's one of the largest. Apple, their net income last year was 100 billion. So for Nvidia to be a 10 bagger at a 40 times multiple, they would have to be 3 times more profitable than one of, or if not the most profitable company on an absolute dollar basis. So that kind of like backwards math, thinking about it.
And obviously they're a global company,
That was,
but that would be about like 1.5-ish%, I think, of US GDP. So
yeah,
their income would have to be, again, just we're talking about absurd numbers, which, right? Who knows? But yeah, great point.
of course. Yeah, I mean, and plus that assumes a 40 times multiple, which is really, really high. So if you assume something like 20 times, then the 280 goes to 560. So it's like 6 times as profitable as Apple.
Yep. That was a good. I enjoyed that part. Let me take then the conversation to part one, because JP pointed it out. He liked some of the conversation from there, where you were just talking about some of the discussion from chapter two and other parts of part one. So in chapter one, he goes and says investing in stocks isn't art. It's not a science, and quote, people who've been trained to rigidly quantify everything have a big disadvantage. And I think I agree for sure. It's a really difficult thing. There's no perfect model, right? We as a team have been working on our own modeling, and there's always going to be subjectivity, uncertainty, variability, whatever, that an outside event can happen that impacts the business in a way that you could have never put into a financial model, right? It's inherently a risky venture. And he talks, chapter 3 is called "Is This Gambling or What?" And in a way, it's informed gambling, right? You're making bets, you're placing bets, you're sizing bets. You're thankfully not, as an individual investor, constrained, like he points out, to Wall Street's whims, which Ted listed, I think, some of them, which are really important to call out. And that's something Klarman calls out in Margin of Safety, which is, of course, also written around this time. So it makes sense, I guess. But, another book that we read several months ago. But this is an advantage, and small investors should wholly take that advantage, that they don't have to buy companies that are in an index. They don't have to maximize, they can only put an allocation up to 5%, whatever the constraints. They don't have to report back to an investment committee on a quarterly basis or whatever the basis is and worry about investors pulling their money, right? It's them. They are the investor. It's their capital. They don't have to be beholden to those silly Wall Street realities, which we're watching some of that happening now. We see hedge fund inflows into the market, into technology, have been pretty large. Are they, finding that the fundamental investment thesis has improved that much in the last few months? Maybe, but it's probably more so. Maybe I can't underperform the other guy, so I need to make sure I increase my allocation to big tech. right? I'm being, my benchmark is the S&P 500, and therefore I need to make sure I have a big weighting to the big S&P 500 companies, the big tech companies, right? These are things that the individual investor does not have to do and shouldn't, follow the same rules as a bigger player who is maybe handicapped in that way. So, I think that those chapters are really helpful in how he writes them, to appreciate that. Chapter 2, definitely don't be beholden to those rules. Chapter 3, the stud poker example, right? If you're playing many hands of poker and you're making the right decisions on an ongoing basis, while yes, each discrete hand is a gamble, right? The entirety of the process, I think, looks less like gambling and more like investing, right? Taking calculated risks. So I enjoyed that in chapter 3. What else do you guys find from that first part, maybe hasn't been discussed, or if it has been discussed, that you agree with, or that spoke to you?
Well, I like just talking about um, investing in something dull, not dull, dull, right?
Dull is
The
dull.
company that does something, it is. It's a company that does something like disgusting, and he talks about the one company that washes like greasy auto parts, which yeah, it's gross, but that was a huge winner for him. So I like that. I think it's great to find a company that's undervalued because it's not sexy. Because oftentimes you just see companies that are sexy but incredibly overvalued because of that, right? And we all know that. Well, one other thing though is his disinterest in tech stocks was something I found a little frustrating because nowadays, at least, if you were to totally write off all tech stocks, you'd be missing out on immeasurable gains. So I'm not saying the market's correctly valuing most of these companies, but it's something I don't think you should just totally write off because you don't understand like the nuances of it. Like he has a complete aversion to it, and I think that's not really fair, or at least not today.
I think also just to go back to the topic of kind of the differences between kind of how an institution invests versus the non-professional. Lynch touches on it, but I think kind of the concept of cash and being in cash. I think from like a fund manager's perspective, if they're going to have a portion of the portfolio in cash, the question is like if you're charging investors fees, like what value are you adding being in cash? So in a way, you're discouraged from being in cash, and like a lot of these funds are like they're 100% invested 100% of the time. um and it's, yeah, I think like being able to be patient, and have some portion of your portfolio in cash and kind of using that to your advantage. I think that that's a significant source of potential alpha that a non-professional has over an institutional investor.
Yeah, and the last year, right, 2022 is a perfect example of what you just said. You had many a fund that had probably a 60-40 allocation rule, and unfortunately for those funds, it was the worst year on record for bonds, for certain segments of the bond market of treasuries. One of the all-time worst years for bonds writ large, and it was a pretty bad year for equities too. So if you were in a 60-40 portfolio, you took it on the chin both sides of the pendulum. If you'd even instead been in, a 50-30-20, if you were an individual investor who wanted to, modify it somewhat and felt like they could, up their cash position. I think that's a great call out, Ted, that the constraints of the institution are something that we as individual investors really should ensure we're not finding ourselves being beholden to. I'll chime in on chapter 4, which I think is just a really good kind of, before you get started, make sure you answer this question, right? And I actually, again, I think the book shows its age here, because the 3 questions that he asks are that the individual investor should ask themselves before they buy a share of anything is, do I own a house? Do I need the money? Do I have the personal qualities that will bring me success in stocks? And do I own a house? I think that a portion of that is dated, given we're in my opinion, somewhat single-family home bubble. I guess depending on where you are, it's certainly. I could afford to buy a house personally, and I opt not to buy a house right now because I don't think it's a great place for my capital. So I guess I would just personally push back on number 1, and I think it kind of shows it comes before the GFC, right? It comes in the late 80s. Him saying that, number 2, right? You should be investing capital that you don't have any need for anytime soon, right? That should go without saying, but how many times do we observe people, I think, putting capital into the market that maybe they shouldn't be? And then number 3 is the most important one of the questions are, do you have the right qualities? And he lists out things like patience, self-reliance, common sense, a tolerance for pain, open-mindedness, detachment, persistence, humility, flexibility, a willingness to do independent research, an equal willingness to admit to mistakes, and the ability to ignore general panic. And it gets back to, not everyone needs to be an active investor. If you want to accept the market return, you can index, and that there is not necessarily anything wrong at all with opting to go that route. You're opting for market returns, right? But if you want to be an investor and you have those, you should have some or most of those qualities. Otherwise, maybe you'd be better suited being an index investor. What do you guys think about the qualities or that characterization?
Yeah, the third question, that especially resonated with me also. The first 2, not too relevant. But the third one, especially kind of detachment, persistence, humility, flexibility. This really hit home for me because it's important for an investor to have the conviction to trust their own logic and really pursue it no matter what the market says, and maintaining the kind of discipline and understanding what one can do to maintain that discipline and actually practicing it is very, very tough. And it's something that has to be done every day to build that perseverance, to build that strength to ignore the market panic when panics do happen. But also on the flip side, I think it's a double-edged sword, right? Because there's people say the market can remain irrational longer than you can remain solvent. So there are kind of challenges to staying with your bet no matter how much the market panics. And at one point, you would need to have the flexibility to be objective and make the call when things do go wrong. And things can go wrong and you could still be right. The market could be terribly wrong and stay that way for a very long period of time until you're dry and out of money. So things like that can happen, and when those things happen, persistence and humility are also really important attributes that investors should have to bounce back up and keep having that conviction and keep driving that discipline to make perseverance even more strong in the future. So kind of thinking about this as a double-edged sword and thinking about what I can do on a daily basis to make to help myself become a better investor is kind of the question mark for me and something that I'll be exploring.
What what Han just described sounded very similar to Burry's Big Short in the previous book.
And not to jump too far ahead, but that I think is part of why Lynch opts not to pursue shorting. What you just pointed out, Hanj. But Alex, thank you for coming on up. Do you want to chime in? Oh, Razor Royal. Hey, man. I didn't realize you changed
Yeah,
your
it's me.
profile.
Yeah, I just became me. Like I'm an actual person in real life.
Love it.
Yeah, it's just like I meet with like executives and stuff, and they're like, "What's up with the wrestler thing?" So I ran out of excuses at this point. But hey, yeah, great space. I really enjoyed the conversation. One of the challenges that's been for me is that I've been a Peter Lynch fan for 2 decades. Been following kind of the value investing strategy, all the rules that you guys discussed. And one of the challenges I have is that we have this big community. It's called the COM, Canadian Oil Mafia, as some of you know. And many guys, many people are traders, right? And so I see the all those kind of rules and behaviors unfolding in front of my eyes on a daily basis. One thing I would add is that, Peter would say, for example, that it's, humility, conviction, kind of stay in the course. I think there's kind of like a quote, I don't exactly remember what chapter it is, but he kind of says that, markets will do what markets do, recessions happen, volatility happens, but, you should be invested in companies that you feel are undervalued, but with line of sight that one day you will get rewarded. One day. So essentially, I think he says timing the markets is very difficult, and one shouldn't do that. So, but reality is, like my community does it all the time. Actual people on daily basis will speculate, be in and out. Decisions are made on a very emotional level. Very often you'll tell yourself a story, and some of those rules will actually work kind of against you because you have this conviction, you think it's something is very valuable, but then it kind of keeps declining on you, declining. You're like, oh, it's even cheaper, so even more opportunity to buy more, but then 3 years later you're like down 70%, and you're still holding kind of the equity, and maybe in like 3-5 years you'll get rewarded. And I actually have good friends that are running money in the community, people that are well known that go on BNN Bloomberg, CNBC, sorry, and manage money. But at the same time, they've been through this kind of valley of death. Going like 4 years losing money and then having amazing 2 years. But one needs to kind of wonder whether the investors even stayed with these money managers, right? So I think like the actual life experience, the speed at which things happen, the behaviors are so complicated. People are blind to their blindness, right? Like sometimes you would make a decision, but then for very automated reasons, without your control even, you'll make a different decision. So at the same time, I'm a huge fan of Peter Lynch. That's why I always I have a relationship with George Noble, a friendly one. But it was remarkable to me to see kind of how he approached the markets when he launched his fund, and him working with Peter for many years. It was a little surreal, but it also was kind of a lesson that, even people that were the closest to Peter and knew exactly what those fundamental behaviors and rules of thumb and heuristics are like, made kind of critical mistakes trying to time the market. So, so this is just some of the input I wanted to share. I think, I am a value investor. I do follow those rules. I do believe that when my companies decline, they become more valuable because there'll be better positions for acquisitions because a peer company could recognize value in them and buy them because they're cheaper. But guys, I think it's such a difficult like when you translate those rules to reality in an emotional environment, it's a very difficult exercise. So looking forward to any thoughts from you on this topic. Yeah, thank you.
Well, Alex, it's a pleasure to formally make your acquaintance with your name, right? I think you know that this is me, Rod. I'm hosting under the Wook profile. But yeah, you make some good points, and it's hilarious you mentioned George because I saw on Twitter today people noting that he put, and I haven't even looked because I just don't care, but so several people comment that he had just shifted a huge chunk of the net asset value of his Nope fund into the Qs, which is exactly what you were, I think, just kind of getting at, that you have professional money managers who, his actions at this point are that of a rank speculator, right? He's just piled capital into what's going up because he thinks it will keep going up and that he can sell it off to somebody else who will pay more for it. And that's okay.
Yeah,
And that's the world we live in. And
yeah,
what's
and
that?
one of the no, yeah, I totally agree. And one of the challenges I think when you do that, and I have a like academic background on the topic, is like the standard deviation around volatility. Because if you're kind of jumping in and out, you're literally playing the variance and volatility, right? Because you're not staying on the course of the trend, whether like it's volatile, on a weekly basis, monthly basis, but the overall trend for appreciation for that equity is realized over time. But when you go in and out on weekly basis, you're really trying to time the markets. At the same time, what's extremely ironic here about this whole thing is that a lot of the computation from the hedge funds is taking place in the server rooms ran by NVIDIA. And so in a way, there's this kind of hidden money washing exercise where this company did well because a lot of computing is going on. That computing is increasing over time because you have a lot of speculation in the markets. And I'm not suggesting that's the only business model they operate. They work with pharmaceuticals. I specialize in the numerical simulation, so we utilize the cloud and run AI models on to predict production in oil sands. So, and we use the server rooms as well, but the market participants are using algorithms to trade against kind of short-term speculators, and in a way, he's trying to make the best decisions for the time frame, but reality is that volatility within the time frame is really standard deviation on the volatility stick, and so. And I think traders probably positioned to make money in this environment. I guess I hope so. I don't know, but I think at least from our community and what I've been noticing, and physically met with many people that do that, there is significant mental health toll on many of those people that trying to kind of watch the tickers and buy sell, trying to time, see a signal go in, but then signal reverses because there is a machine on the other side doing that, and so. And we live also in this world where you're hungry, you order something online, and within 20 minutes you have exactly what you wanted, or you press a button and you get you get the channel that you want, or you press another button and you talk to people you enjoy talking to. And so here the markets are not like that at all, right? You press a button, but it's like a 50-50, and the more you do that, the more you kind of taking on risk, and we know through Daniel Kahneman loss aversion theory, where we feel the pain way more than we feel the gain, right? And so there's this whole kind of mental aspect there where, like, and I think it comes from really evolution when it comes to if you hungry, you may go with another day being hungry, and then another day, and then your wife is hungry and your kids are hungry, so you start panicking. So that emotion is very enhanced because there may not be another day for you to survive. But if you healthy and happy and eating well, the next day you'll just eat again and again and again. So you don't have that emotion as enhanced for a human. So you almost incentivized to panic when you feel pain. And I think that's why that loss aversion prospect theory is so powerful. in addition to Peter Lynch's input, right? And that's why sometimes I think, you just kind of buy value and hold it and just ignore it. But it's so difficult to do. It's so impossible to do in this world for people. And I think majority of people really struggle with that.
I think you are spot on that the changes in the world, this uber connected world we all live in, make it even more difficult for you, a prospective individual investor, to just sit back and actually invest and wait for the quarters and years to go by and for your thesis to either be proven or disproven. Instead, it's so much a very reflexive, whatever line is going up, I want to chase that. I want to buy that. I see my friends in this chat, in this other server I'm in this other whatever spaces I'm in, talking about this shiny object. Now I'm spending more time looking at lines on a page about that shiny object than I actually reading about a new investment idea or a prospective idea or a different segment or whatever that you've never dug into before. So I think you're right. It's unfortunate. And I know I'm guilty of it, probably all guilty of it to some degree, of the allure of that very short term.
And it's very human of you, because guess
Mm.
what? Human race didn't have to leave Africa, but we did, and we migrated. And so there's always this aspect that, let's say you move with your family for like 2 months, and you find this spot with like a palm tree and little lake. Some will be like, I'm just good to stay here. I love it here. Some will say, well, what if we find even better lands? And then they end up in Greece or like Italy, somewhere nice, or even in Hawaii, where it's like an island full of resources and food and warmth and so people, we have this natural incentive to pursue, to be better, to find something new. And so when we get that natural FOMO, when we see Nvidia jumping 30% and you hold your stuff, you're like, oh my god, why am I not there? You chase that and you get stressed. So with Peter, I think Peter kind of lived in that time when you didn't maybe have the speed that we experience today, right? But I think the fundamental rules are still intact. Also, what's really interesting, and I would love to hear from you guys on that. So my parents are very religious. So I'm a Jewish guy, but I'm not religious at all. And in the Bible, they will pick and choose certain things they like or don't like. So they will say, well, this doesn't make sense to me that this guy killed all those dudes, so God wouldn't want that. So let's just ignore it. But then some things like don't cheat, don't steal make a lot of sense. So I find like we sometimes pick and choose things that like, oh, I have to be patient, I have to be humble, I have to be open-minded. But I shouldn't own a house, for example, because the market is different now. So sometimes I feel like, and by the way, like if you don't own a house, like I live in Canada, for example, our house prices dropped significantly, but now it's back to all-time high because of immigration and all that. So sometimes I feel like, like logical stability with taking minimal risk makes sense. But sometimes I feel like, we also pick and choose kind of rules and what works for us and what doesn't work for us. We're very good at saying, oh, that's just not a good idea. So I find that also fascinating.
I would definitely just take it back to the book and kind of that discussion on knowing thyself and the attributes that you have. I think that really is very underemphasized. If you are an investor and you know you have certain attributes, maybe you don't have a tolerance for pain, you are not persistent, you are not willing to do independent research, right? Then you shouldn't be actively investing. You should choose some passive index funds or find some active managers you'd like. Let those people manage your money. Let the index let the market return be your return, right? So, I mean, we're of course approaching the conversation with the context of an enterprising individual investor, somebody who wants to do this and learn this. I think it really is vital to step back and truly check. Like, I know for a fact I have a very high tolerance for pain. I'm a okay, and it's probably to risk management is something I can get better at on my personal account. If you shouldn't be seeing things draw down, 70, 80%, I guess. But sometimes if I see that, and it gets back to what you said, if you've done the research and you have a conviction in whatever outcome or thesis, and just because the price goes down, then the point should be true. You should, and Lynch, I think, makes that point in the book that if you see the price go down and your initial reaction is to sell rather than potentially want to buy more, then you shouldn't own it at all. If the idea of 10% decline would scare you, or you would want to sell the stock, you shouldn't own it in the first place. But you really do need to appreciate, I think, what type of investor you are. You're not going to have every single quality. You're going to have certain qualities, and that should inform the way you invest, I think. Because if you're inherently, like I think you and I probably are, more value oriented, that which we can quantify and see, and yes, we're talking about future cash flows, sure, but we can get a better grasp on those future cash flows when there's either a piece of machinery or a real operation behind it, rather than maybe some just spark of an idea and some code. And that for me is easier to invest in and feel confident in than being more of the growth type investor, which that's difficult. So I think it's knowing thyself for this first portion of the book, where preparing to invest is the name of it. And I think that is just the most important thing in this, is to understand yourself and align how you act, to make sure you're not setting yourself up for failure in your investing journey.
Yeah, I think one of the most powerful learnings from Peter Lynch, for me personally, it's kind of the concept of knowing what you own, but not in a kind of shallow way. It's more about kind of what is that you know that maybe you do for a living, or see around your house, or see the demand increasing or declining for a product or a service. What is the thing that you have like an edge, or something that could benefit your comfort zone, knowing that this thing is there, right? Like if you, let's say, invest in certain company that produces milk, but that's the one milk you really like, and everybody buys that milk, or toothbrush, or I don't know, whatever it is, right? Because I think this is a better alternative in my case, for example, it's heavy oil companies. So that's my specialty. I know the sector very well, so I kind of take comfort in parking a lot of my wealth in companies that I feel that undervalued. I find
it's
very
funny
powerful.
You say that, because Lynch makes the point that a lot of the times people do the opposite, right? People who know a lot about the oil industry, like you. In his book, he cites that they're more apt to invest in maybe technology, something they don't understand. And I think he makes a very good point that you should invest in what you know. And the corollary for me is, I worked in corporate strategy at Ryder. I understood electric truck adoption and how that was going to play out better than 99% of the population. So now I have a very large investment in Allison Transmission, because I think I have a more insight than the market on how they're pricing Allison's, future cash flows. Allison's, one of those value stocks. It's trading at a 6.5 forward PE. The market doesn't like these stocks right now. The market probably won't like it for a long time. It hasn't liked it for a long time, but multiple compression can only go so far. And eventually, over a long enough period, usually share price aligns with earnings per share growth, or free cash flow per share. So that I think is a good example of oil. I understood the transportation and logistics industry pretty well from my time doing that, and I identified a company within it that it fits a lot of the chapter 8 lines. It's dull. It's not a growth industry. It's in a niche, et cetera, et cetera.
Yeah, no, for sure. And at the same time, you don't have to be a maxi necessarily, right? Like you can see other kind of pseudo services. For example, if you have some kind of data center, and you notice you used to have some bunch of IT guys, and all of a sudden, like one of those CGI groups are running your data center from India or something, using like those cloud servers. You know that your IT guy doesn't exist, so that third-party company does all those, products. And so that's why I think CGI is in Canada have been doing so amazing, right? Like you probably know that stock. So this solves another problem for me, which is even more important. One observation I made is that we have like a show here in Canada. I don't know if you know this one, a market called BNN, where guests appear and provide recommendations and top picks, and then they come back after like 6 months and they review their past picks, and then they provide new top picks. And often, the past picks will be down significantly. And very often, what you will see, it's a very psychological response to like, oh, we got stopped. Shortly after we recommended, the stock performed well, as you can see in this chart, and then we were out because there was this, we diversified to a different. There is always like an explanation, and my point to this is that you cannot borrow somebody else's conviction, and they will never tell you that they sold. They'll be very good at telling you, "Oh, this is great," but there will never be a follow-up. So I feel like Peter Lynch's point here, and that's kind of how I connect the dots back to him and that thesis of kind of knowing what you own, is that you can never borrow somebody else's conviction, right? And they will never tell you what they do. Sometimes they could tell you to do one thing, and the next day they do something absolutely different, because that's how people are, Maybe they didn't sleep well or had too many drinks the night before, maybe changed their mind, maybe their wife left them like after a week, and now they have to sell half of their shit. So I think like, and that's where you become a big boy, right? That's how you kind of evolve as an investor. You kind of like, I know what I own. Those are like, I'll be calm about this. If it declines to that level, maybe my thesis is wrong. Maybe I should get stopped here. But if maybe some of you could say, well, if it declines here, then it's cheaper. Maybe I add more. But as long as you're mentally kind of healthy about the process, I think it's good. The one thing I noticed, like,
Well, even more important is the word process, that it should be a
yeah,
structured process, and it should be in the
good.
context of a diversified portfolio. That if you're an individual investor, you should have several positions, and you do have to think about your actions in the context of, and Lynch talks about that a little bit in the book, how to adjust your position sizes, etc. But I think that just having a process, it doesn't have to be a super detailed one, but such that it's not just on a whim or on an emotional reaction. Right?
Yeah, and I think like also a lot of the way we're being brought up in our cultures, regardless of where you're coming from, especially if it's like a developing country or something. There's a lot of cultures where your parents told you to work really hard to achieve something. And I feel like sometimes people in the stock market over trading, thinking they're working really hard and they need to be stressed because they work hard to achieve that one thing. But most of my success, like getting like really amazing performance in stocks, was always because I was sitting on my hands, right? So I think there's kind of this Peter Lynch kind of learning where like the 10 beggars, they come from you just maybe not selling, maybe having that conviction, maybe seeing a catalyst, maybe giving it some more time than your kind of emotions telling you. I think it's such an important and fascinating topic. Most of the spaces they will be about, oh, what did the Fed do today? Oh, what's the next rate hike? Oh, what should you buy today? And where I believe like this space, what you're doing here is so underrated, and it's probably the most important topic of all, right? How people respond to markets, how people respond to market movements, and how stock movements, and what is value, what is trading, like how often should you do it, what is a discipline, what's a comfort zone, I feel like we never, in my community, we're so guilty of that. We never talk about those topics, right? But I feel like, after a while, you just pay with your mental health, right? And that's kind of what I see in a lot of people. And it's too bad.
Well, being a value investor has felt like a big mental burden this year to date, I will say, with our underperformance relative to growth. But no, thank you for that. And we do these book clubs the last Tuesday of every month. So we're halfway into the year. I think this is our sixth. So we have a lot. We've gone through margin of safety. We're obviously talking about One Up on Wall Street tonight. We've got the book list. Joe, do you have the full list in the pins? If we could put that in there too, that'd be
It
good.
is on Twitter.
Okay.
I'll throw it in the mess.
Okay, great. So yeah, look, this is just one piece of programming we do, because I think you're spot on, Alex, that there's and there's plenty of discussion on the goings on of the day, the shiny object of the day, the earnings call that's coming up, and what the expectations are, and how much of a move is priced, and yada yada. And we're not going to win competing, I think, on that. And there's no need to compete on that. There's plenty of people having those discussions, but I think we're trying to approach from a fundamental value investing oriented mindset of helping a lot of younger investors kind of came into the market, and we've become acquainted with over our short existence as a fund. So we know there's a lot of educational opportunities out there, and unfortunately, I think a lot of people are learning the wrong habits that you were kind of alluding to, that they're just being hyper short-term oriented. They're feeling like activity is something they need, when if you're investing, you shouldn't, your activity statement should be if you have a quarterly dividend, that should be your activity on your security for the most part, right? That, or if you're dollar cost averaging and you have a weekly every paycheck, whatever, you're putting X percent into the stocks. But there's just, you're right. I see very few of those sorts of discussions, and they're just not sexy. Let's be frank. The shiny short-term trading stuff is a lot sexier, although it's, for many, probably to their undoing. Most traders don't make money. Most day traders, the vast majority of them, lose their bankroll pretty quickly. So, it is the way of the market, and hopefully we can prevent some people from having to go through that expensive learning. I'll shift the conversation forward a little bit just to the second part. Just we're at 9:11. We started at 8. So we talked about in section 1, the preparing to invest, how unimportant the formal education is, some of the importance of the mirror test, knowing thyself and thy attributes, knowing that while there are gambling-esque attributes of investing, that it is more like betting when you have an informational edge or advantage, and betting heavy in those instances is maybe a better corollary than just being at the table and mindlessly drawing cards, right? So we've got, I think, some good chapters in this section. Talking about, he leads off with stalking the 10-bagger and talks about some of the ways in which people can get exposure to the next 10-bagger. Talks about the research that one needs to do. I mentioned earlier the 6 categories that Lynch sets up: the slow grower, the stalwart, fast grower, cyclical, asset play, and turnaround. And then what Han noted, which I think is also just excellent and really can't be overstated, the perfect stock, where Lynch lays out what are these attributes of the perfect stock: sounding dull, doing something disagreeable, being a spin-off, not being covered by institutions or analysts, having negative rumors. There's something depressing about it. I think the Service Corp International was a fantastic example. He called it a Mick burial. And if you look at SCI, you can look at a long-term price chart of SCI and see just fantastic shareholder returns, even though the book was written in 89, right? If I go and look at the share price, if I can get my computer to work here, they've just had wonderful returns. So in 1989, depending on when Lynch was discussing it, it was around $6 and change. It's been a 10-bagger now in the 30 odd years. Granted, it's paid a dividend too, so just looking at the share price isn't going to tell us about total return, right? But it's at $65 today. It's at 20, 21 trailing PE. It's Service Corp, again, from the book, if you recall, is the cemetery kind of and funeral provider. So it's a business that I thought it was funny. It's actually rolls up under consumer discretionary when I looked it up in COIFIN. I don't know how discretionary funerals and cemeteries are. I mean, yes, to some extent it is a discretionary, but I think it's more like a staple than a discretionary. But that being an example of a business it's not sexy at all. It's certainly depressing to think about, but it's had a wonderful performance, even after Lynch wrote about it, right? So the no growth industry, the niche player, the consumable, right? People have to keep buying, insider buyers and company buying back shares. That's his perfect company. So I'll pause there. Uh, maybe we can focus on that one, the those attributes for a second. Um, what are maybe some examples of other companies, maybe modern examples that fit the bill of some of those that Lynch threw out for those attributes that are attractive.
I'll just add, I did put the balance of the year book list on the Nest. So up next is Think Twice for June. And obviously, we're still waiting on a final release date for Degenerate Generation by Nathaniel Popper. We're hoping that'll be a great one because both Rod and I provided some insight into our experiences with GME, which is what the book's about. So that'll be cool. Kind of have some maybe of our own stories told in there.
Thank you, Joe. I'm just thinking off the top of my head, something dull and I guess potentially disagreeable that I know the value investors up here would probably love to hear is Geo, the private prison company that Mr. Burry had been invested in. Right, that's probably a good example of it's. I guess it probably fits something depressing about it too. It's private, for-profit prisons.
Yeah, that takes the cake on unsexy businesses. it's pretty, it's pretty, it's pretty bad.
I mentioned Allison earlier, but I would say Allison Transmission fits the core kind of legacy business. There's no meaningful growth in a number of on-highway trucks. That's modest growth at best. It fits a niche. There's only a couple of automatic transmission makers worldwide. Um, it certainly sounds dull. Allison Transmission. I, I I don't think it's super dull, but it does something dull. Whether it's the transmissions for an oil rig or for a truck or for a piece of mining equipment, it's not something that gets people riled up.
Rod, could you maybe walk all of us through on what those attributes were that make up the perfect company?
Yeah. So Lynch says that the perfect company would be one that sounds dull, does something disagreeable, is a spin-off, is not institutionally owned or analyst covered, has been subject to negative rumors. There's something depressing about it. It's in a no growth industry. It's got a niche. He notes that brand names can fit there. People have to keep buying it. So it's a necessary consumable or technology. It's a user of technology. The insiders are buyers, and the company is buying back shares. So if all of those things were present, he gives an example of a fictitious company that kind of has all those attributes in the chapter 8. But those are the attributes of his perfect stock. So I mean, inherently, I guess then the logical inverse of those attributes would be the thing to be avoided, right? He follows up in the next chapter with stocks that he'd avoid and the most popular stock in the most popular industry. Well, that sure sounds like Nvidia uh, at this moment in time, right? Um, he definitely emphasizes to avoid diversifications. So many times when businesses are diversifying outside of a core competency or trying to make some sort of adjacent move, if it's not something they have experience doing, or it's not some serious synergies that can be realized between bringing those businesses together, then it's probably going to end up being a diversification. There's been plenty of research by McKinsey Institute over the years showing that most M&A is value destructive, not accretive. So typically, seeing businesses that are serial acquirers is a red flag. He notes, quote, if a company must acquire something, I prefer it to be a related business, but acquisitions in general make me nervous. There's a strong tendency for companies that are flush with cash and feeling powerful to overpay for acquisitions, expect too much from them, and then mismanage them. I'd rather see a vigorous buyback of shares, which is the purest synergy of all. So what are maybe some other stocks then that Lynch would avoid, or that would hit his get his deal juices flowing?
Well, I can speak to that,
Yeah, please.
but I have maybe like a little bit of a bias kind of example, and maybe not as much. So I think like, are you Canadian? Are you from? Are you
I'm
American?
I'm a Long Islander, actually.
Okay. So we have a lot of like infrastructure plays here in Canada, but I think same applies for US. And by the way, I work for like a Houston super major, so it's like I don't really have a huge bias, but so I think like and another recommendation, obviously, right? But I think names like uh, TransCanada or AltaGas, ticker ALA. I don't have a position, by the way, but based on what you were asking, those could fit those criteria because nobody likes natural gas now. It's like such a dog, but at the same time, you need to process natural gas and kind of handle it and distribute it, and those kind of infrastructure assets they don't become more common, and they would buy back stock and do all of those things you talk about, and it's very dry, not sexy, right? In my mind, the best example of that will be a small oil sand producers, um, companies like Mag Energy or Tabasco Oil, right? Where the people think, oh, it's just a play on oil. Oil prices are down, so those guys suffering. So I don't want to do that. But reality is, most of those companies, the cost of supply or break even is like $40. Like, how many people know that? So oil price needs to be $40 WTI for you to break even, right? It's silly, right? So when price goes from like 80 to 70 or 60, it's like, oh, it's a six handle. It's horrible, but it's not that bad actually. And yeah, since February last year, those companies were able to pay down a lot of debt. So, for example, in the form of a Tabasco, their enterprise value used to be like, I don't know, like 100 million, and debt used to be like 400 million. They were like basically going under. Right now, enterprise value is about 1.6 billion, I would say Canadian, maybe, yeah. But there's like 50 million debt. So they paid down debt aggressively, and now they committed to buying back shares, right? Because they met their debt target, which is very low. Um, and what can be more not sexy than like a heavy oil small play in Canada? It kind of goes against all of those. Even though those companies are doing amazing job in like reducing emissions and having ESG policies and integrating like new technologies, but people just don't know those facts, right? Which is fascinating. But I think it's a little bit kind of like that now, where Nobody cares. People just ignore that segment. People look at price of oil and like, oh, those guys must suffer. But reality is different, right? And so I think there's some opportunity in that sector. But also like, names like CN, CP Rail, right? Like just like rail companies. Like nobody cares, right? Um,
Well,
maybe some of the
rail is a
major,
great example, right? That those railroads will be
yeah,
around long after we're all dead.
that's right, that's
So
right. And
very
remember, lots of,
unsexy, but necessary.
yeah, remember lots of the oil companies, like the heavy oil, there's no battery for airplanes or diesel trucks or heavy equipment. You can't just attach a battery to an airplane and fly. You could, do that obviously
Well, I was going
with
to
a
say
Tesla. Yeah,
refineries are another segment that fit the bill,
that's
and you
right.
just you just answered it for me. So thank you.
Right? Or asphalt, like or shingles on your roof. You can't barbecue propane your shingles. You can't battery lithium design your asphalt on the road. You can't do it with the tires that you use the car for. You can't do it with the plastics, with the phone that you hold in your hand. So a lot of those really boring materials that come out of hydrocarbons are being totally ignored and hated. And maybe some of the listeners could say, "Oh, that's dumb. Why would I?" And that's exactly what Peter Lynch is probably saying, right? Like that's the boring stuff that you need because you will be using your phone for the rest of your life. You will be driving on asphalt for the rest of your life. You will have shingles on your roof for the rest of your life. So, and if there are more people in the world, we'll need more of that. And guess what? In developing countries, they don't have the things we have, right? And they want those things too. So I think there's a lot of kind of value, logical value in those type of plays, but it's really hated. Like people hate, just don't want to be associated with that, right? Because Nvidia is just so sexy, and I don't know, like an Apple is just, you can see it. It's like Apple is a great brand. So, but anyway, some of my thoughts, but obviously not a recommendation, guys. Just to keep the conversation going, I guess. And maybe fertilizers, even nutrient like companies like that, Mosaic, maybe I don't know. They're so hated, but to grow food, I mean, we eat more. I was just in US. I took my family to Phoenix. We drove up to Vegas, spent lots of time there. The levels of obesity in US just unbelievable. No, like who talks about that? And in my mind, it was like, man, diabetes is going to be like a thing for like a huge thing. Like for people that are in their 40s right now, they're like super overweight. In 20 years, they're going to be like, there'll be consequences to those eating behaviors, right? And so who cares now about like a Johnson and Johnson or like those diabetes companies, right? Like, anyway, I don't remember the names. But yeah, back to you. Thank you.
Oh, good stuff. Good conversation. Thank you, Alex. I think healthcare, to that point, there's a lot of stuff in healthcare that's not sexy. Maybe going away from the more speculative stuff. I know I've brought up the point something like a CVS Health, which is towards the cheapest it's traded in the last decade. It's cheaper than it's ever been since the Aetna merger. And is CVS Health going to be going away? Right, that the business has its own idiosyncratic risks, including the pharmacy benefits management and whether regulatory change could strip that away, et cetera. But the healthcare sector inherently, the U.S. unfortunately is the largest consumer of healthcare per capita in the world. We are likely to continue to be, and we are likely to continue consuming more and more healthcare. And are there ways to get exposure to something like that? Maybe it is dull and maybe it's niche, but you can play on maybe a longer term secular trend. And I would agree with kind of Alex's notion that for all of the pomp of non-fossil energy production, the reality is that fossil energy production is likely to need to continue to rise for many years to come to support world growth, ex-developed world growth, um, unless we want to live in a world where we don't, see people being able to use electricity and use the internet, right? Going back to what we were talking about earlier with the internet, Joe, I saw that only 1 in 5 people in sub-Saharan Africa have access to the internet. So, whether that's still 100% accurate or not, it kind of shows, though, right, where we I think that goes back to, oh man, the book is eluding me right this second. Psychology of Money. There it is. We talked about with Morgan Housel's Psychology of Money, and just the luck of being born, right? Of being born into the United States or into Canada or into a developed country, South Korea, whatever. And especially for, say, South Korea, the luck of being born on the right side of the parallel, right? If you were born on the wrong side, how different would one's life be just because you were born, 30 miles north of somebody, else. So there's so many things to be thankful for and to appreciate, and to recognize those. We just having this conversation, our ability for those of us, we have cellular devices, we can afford to pay a bill, and we can afford to be tuned into this discussion we're having, with people that are located on multiple different continents right now. It's incredible.
Want to hear something funny? I have this really good friend of mine, Josh Young. I don't know if you know Josh.
Yeah.
He manages an oil fund. So Josh, back in the day, had this intern, and his name was Morgan Housel. So I think he talks a little bit about how much he hated his job and his boss. So I wonder if he talked about Josh. So it's kind of a funny fact. But Josh told me that they used to work in LA, I think. I'm not sure for which, maybe Goldman, one of the bigger ones. So yeah, it's a funny kind of connection there,
I'm just looking at the time. So before we move along into the last third section, I wanted to, see if there were any more comments on section 2 on that picking winners and what to look for. I'll say I really enjoyed his categorization of the different types of growth, the cyclical, the turnaround, the asset play. Because I always find myself intrigued by asset plays, right, where you can kind of figure it out for yourself that the parts are worth more than what the sum is currently trading for, and of course those can be dangerous if there's no catalyst. Lynch notes that for those asset plays, you typically need, I think says, using 1980s parlance, a raider needs to come in, and shake things up. But I don't know. For me, I like the asset plays. I like the turnarounds, the cyclicals. I don't know if anyone finds themselves drawn to some different companies. The fast growers, of course, are the ones that are really the most exciting, and the ones that the market is in love with right now. But I don't know. Any other comments from the panel on this section? Okay, so I'll real quick then kind of go into part 3 of the book, is the long-term view. So he in this section talks about how one should consider designing a portfolio, when one should consider buying and selling. Silly sayings about stock prices, some comments on options and shorting. So I'll quickly kind of summarize, I guess, so in his portfolio design, he makes the point that it's a numbers game. If you're trying to get big wins, 10 baggers, as he calls them, get 10x return on your investment, the more stocks you own, the more likely you are that one of them's going to turn out to be a 10 bagger, right? So Lynch obviously would invest in hundreds to thousands of individual companies. He's going to inherently have a higher likelihood of having some 10 baggers than somebody who only has a 10 stock portfolio, right? And I think the point about the ability and the flexibility to rotate funds between the stocks you own, if you own just 3 stocks, it's going to be a pretty simple rebalancing, right? If you own 20 or 50 stocks, you'll have more opportunities to maybe decide to size down one or size up another. So that's some of the discussion on his portfolio design. And I highlighted and bolded the line from this chapter. If you can't convince yourself when I'm down 25%, I'm a buyer, and banish forever the fatal thought when I'm down 25%, I'm a seller, then you'll never make a decent profit in stocks. It goes back to, if you're actually making an investment, you should be delighted that you have the opportunity to invest at a better price. Whereas, if it's more of a speculation, oh no, it's gone down, let me get out of this so my stop loss can save me from losing more money, then it goes back to the what is it that you're looking to do? Are you looking to buy a company, or are you just trying to flip this to the next person for a quick profit? His comments about when to buy and sell, obviously, again, this is from 1989, but his point about year-end tax selling, I've found to be true in my investment career. That every year is of course different, but there's always seems to be a lot of sales, stocks going on sale in that last quarter of the year when people are just selling for the sake of realizing a loss because of how the tax code works. This past holiday season, right? If you just bought on January 1st, you'd be doing pretty nicely. You bought pretty much anything except for the value stocks. But that timing point he made, and then of course when there are in fact crashes, that's when you want to be buying, when people are forcibly selling, and you want to sell when everyone is saying that you should buy, right? Everyone is saying you should buy AI right now. Maybe it's time to sell AI. But on the other hand, you could certainly go on farther. So again, just what is it that you're looking to do? Are you looking to make an investment, or are you just trying to play the game? There's one other. Let's see. There's another one. It was interesting. He made the comment. Again, this is maybe a matter of when, but Alex, he's probably not changed his mind on this one. He in the chapter on options, futures, and shorts says, quote, "There's no point describing how they really work because it requires a long exposition, and I don't understand them myself." Which he's probably being a little facetious there, but he definitely voices a view in the book that utilizing options and futures are taking on more risk and likely lining the pockets of whoever you're paying the commission to, more so than helping yourself as an investor. But I'll pause there. That's mostly the back section of the book. I don't know if folks on the panel have any kind of comments or thoughts on part 3 from Lynch and what he has to say about the long-term view. All right, well, hearing crickets, I'll posit one other thing then, because there's another value investor, David Einhorn, who has kind of voiced this thinking recently that maybe is value investing really dead? Because Lynch makes the point in the book that, for example, quote, "Stock prices often move in opposite directions from the fundamentals, but long term, the direction and sustainability of profits will prevail," right? In the long run, the free cash flow per share should be, as free cash flow per share rises, the share price should roughly move up or down to measure it with free cash flow per share. There's clearly a lot of value stocks across a lot of unloved sectors who seem like they're just perpetually being mispriced. And Einhorn makes the point that perhaps in this market, where you have such a huge contingent of the market just chasing, just hot money, chasing into the shiny objects, less, investors really trying to dig in and suss out, value and dislocations, that those dislocations won't correct themselves unless there's an external force, whether that's, say, the company buying back stock or an investor accumulating an ever larger position. I guess I'll pause it for the panel. And do you have thoughts? Do you think Einhorn is onto something that, is value investing maybe permanently impaired in this new world, or is it just we're in a very, very long cycle that the Fed has led to value being out of favor, but value will eventually come back? What say we? No one's gonna humor me. Okay. Well then, hearing silence, I'll leave it for folks if they want to go around and share any last thoughts on the book or value investing in general before we close things out.
I guess as like a final thought, like on the topic of timing, like we touched on it before, Alex brought it up. Trying to trade the market over a very short period of time and kind of flip flop in and out, and trade kind of these like low conviction bets. The way that Alex described it before, he basically said like you're trading volatility, right, over a short period of time. And then to what you were just now talking about, Rod, how, by trading the market over a very short period of time, you can't really, I mean, yes, you can use like a value kind of a framework, but it's more trading versus investing, right? And like over a longer period of time, to what you were saying, like the ultimate arbiter of value is earnings and free cash flow. And in every single stock chart in the book, Lynch shows both the price chart, right, and the earnings chart. And you basically see how over time the price performance reflects the earnings trajectory. So, I would just kind of end on that. And as like a last and final thought, like in terms of trying to time the market, I think, in general, it's very difficult, I think, to time the market. I think being patient and kind of using time to your advantage, kind of one of the key things you can do as a retail investor, and looking for certain kinds of setups either in the market or for specific companies, right? And to what you said before, Rod, you were like basically talking about, buying fear, like that kind of a setup. It takes patience, right, to kind of wait for something like that to happen. If there's mass fear in a particular name or for the market as a whole, kind of buying that fear. And then once there's like, once there's a lot of excitement and like everyone's buying, kind of using that as a time to potentially scale back. I completely agree with that. And yeah, I think you could kind of, as a retail investor, if time is on your side, there's kind of a time arbitrage that you can do where there's arguably more alpha to be had, on the back of earnings, right? Versus what a lot of hedge funds will do is they'll try to trade earnings, right? And like during quarters, right, they'll try to, develop some kind of edge going into the quarter for a particular company. And doing that consistently over a long period of time is very difficult and very few people can do it. And I think if you look at the most successful investors, whether if it's Buffett, Marx, Klarman, they've they have the track record that they have, not because they pick quarters, but because they follow, I think, more of a longer term strategy where they look at value kind of over a longer period of time and have that kind of like longer term earnings, free cash flow tailwind behind them, right? Versus trying to pick out quarters. And I think it goes back to, timing, being patient, and kind of waiting for the setups that you feel the most comfortable with. And ironically, like, successful investing is kind of putting your money into the market when it feels the most uncomfortable, right? Like by definition, that's how you over time kind of outperform versus trying to chase and buy something like Nvidia today. Benjamin Graham's got a quote. He basically says that by the time Wall Street determines that a particular stock is the best one to buy, its price has been bid up to a point where future returns have nowhere to go but down. And the opposite of that would be when there's fear, price is down. That's kind of like the best time, right, to buy, and just let time, pass and kind of work in your favor.
Those are great points. Thank you very much, Ted, for sharing that.
Of course.
Any other folks on the panel want to share some final thoughts on the book and how it relates to their investment philosophy?
Yeah, I think it's important not to listen to anyone.
Come take a shirt, dude, please.
Disregard everything we said because we are actually shills trying to prevent you from buying Nvidia and making life-changing money. I'm just kidding. But it is a good point, and it will dovetail nicely actually with our next book, which is Think Twice, Harnessing the Power of Counterintuition by Mike Mauboussin. Michael Mauboussin is a really fantastic finance writer. He's been writing about strategy and economic value and all sorts of stuff in that world for a couple decades now. So next month, the last Tuesday of June, we'll be talking about Think Twice. And that book, too, emphasizes what Alex, tongue-in-cheek, just said, that we often over-rely on the experts, the people we think know more than us that must have the right answers. And in fact, oftentimes we should be ignoring what they have to say and try not to let that guide our thinking, and instead, really look at what is happening and look at the truth, look at the facts on the ground, and come to an assessment of our own. And perhaps it aligns with the expert, but we shouldn't just be reliant on experts and forecasts, etc. But yeah, we'll get more into that, of course, next month. I think again, this was a really good. There's a lot of overlap with some of the themes we've discussed in past book clubs. All of these recordings are available on our YouTube channel, Wook Capital. We've got them all uploaded from the previous discussions, which you can see the book list for Balance of Year in the Nest, and you can see Margin of Safety, Psychology of Money, Little Book That Still Beats the Market, Big Short. Those replays are available, but a lot of overlap in a lot of these themes, right? And whether the book was written 30 years ago, or whether, as Han noted earlier, it's Out the Fox's Makings of a Multi-Bagger just from a few years ago, there's a lot of overlap in these kind of foundational elements, these axiomatic things that kind of hold true over time, even as the world changes around us. So while history doesn't repeat itself, it certainly often rhymes. It very much feels, like we said, like Lynch pointed out in his foreword, it very much feels like that .com era where this very narrow market is being pulled upward by a couple of mega winners. And we'll see how things pan out. But Thanks everybody for joining on this, our latest edition of the Wook Book Club. Thanks so much for my teammates for joining in, Ted and Alex. We appreciate you joining on the speaker panel. We'll be back on, it's Tuesday night, so tomorrow night, Wednesday night, I'll have my market open mic at 7 Eastern on my @RodAlsman handle. So please join us in just shooting the shit about whatever it is that we want to talk about. Perhaps we will talk about some macro stuff. We do those every Wednesday at 7, and then Fridays at the close. Although we are intending on changing the time for now, we are still doing Fridays at the close with our Wook and Review. So 4 p.m. Eastern, join us for our Wook and Review this week. So thank you again, everybody. We appreciate your interest, and we hope to continue to put out, interesting and differentiated content for investors that is not just us talking about which stocks are going up and which stocks are going down today. So cheers, everyone. Good talking to you all. Have a good rest of your evening.